An extremely busy week is coming up, especially for the US dollar, the yen, and the euro. So let's get right to it. I'm Cristina Marujos. This is the week ahead at XM.com. And joining me today is our lead market analyst, Raf Boyajian. Rafi, starting with the United States, we're essentially just a week before the U.S. presidential election, and the dollar will have to digest a slew of important data releases. We have GDP and PCE inflation on the menu, followed, of course, by the all-important employment report. The non-farm payrolls report is out on Friday. How do you think the dollar will respond, and what are we likely to see in the data sets?
Well, Christina, indeed, it's going to be an action-packed week in terms of economic data. All those crucial economic releases coming out of the US, which will guide us into the Fed's November policy decision. Now, of course, we had seen quite a bit of paring back or rate cut bets for the Fed following the September meeting, because even though we got that surprise, bigger than expected rate cut, the data since then had been pretty strong. And so it's going to be interesting to see what we're going to be getting in the upcoming week, because of course markets are now kind of starting to doubt whether or not the Fed will be cutting rates both in November and December. So there is the risk, of course, that if we get a strong set of data, maybe markets might become even less confident that we're going to get 2 25 basis point rate cuts in 2024. And that would, of course, further bolster the US dollar. So starting with the GDP report on Wednesday, the forecasts are pointing to 3% annualized growth, but the closely watched Atlanta Fed GDP Now model, that's telling us the economy probably grew by 3.4% in the third quarter. So the risk is tilted to the upside, and that would, of course, be positive for the dollar. Now moving to the PCE inflation numbers, we saw in the last CPI report, it was a little bit mixed. The core rate edged up while the headline rate headed lower, and we had a similar trend already in the PCE data. So should we see further divergence? I think for people to feel comforted by a drop in the headline figure at this point, they would also have to see a drop in the core PCE price index as well. Otherwise, I think we might see some renewed concern about sticky inflation, and that's not going to bode well for aggressive rate cut bets. And finally, of course, with the jobs report, of course, last time we got a strong one. We saw the unemployment rate dropping to 4.1%. It's expected to stay at 4.1%. Should we see, though, the jobless rate head up unexpectedly? I think that would probably encourage bets of back-to-back rate cuts, both in November and December. With the headline figure, with the headline payrolls change, that figure is expected to moderate 240,000 from 254. On the whole, I think the closer we are to 100,000, I think that's going to be good in the sense that the US labor market is slowing down and the Fed will keep on cutting rates. So on the whole, I think the risk is probably tilted a little bit to the upside in terms of the Fed rate cut bets being pared back and the dollar extending its rebound. But of course, any downside surprises would have the opposite effect, and that would also be positive for equity markets as well.
Now let's look at the yen. The Bank of Japan meets on Thursday, just days after the snap election of October 27th. And it will be interesting to see if Bank of Japan policymakers consider tightening policy further, given the fluctuations we've seen in the yen recently. What do you think policymakers will signal?
Well, I'm glad you mentioned the yen, because the yen, the strength of the rebound, the sharp rally we saw in the yen earlier in the summer, that's actually one of the reasons why the Bank of Japan's kind of turned more hawkish, because they were kind of signaling more rate hikes down the path, but the fact that the yen reversed higher, I think that lessened the pressure on them to act sooner rather than later. So now it's the focus is much more on inflation, and inflation seems to be settling around 2%. So we're not seeing renewed upside pressure on inflation in terms of inflation heading up towards 3%. So I think the Bank of Japan is in a bit of a wait and see mode, and it's likely to stay there for the next few months. But of course, it's hard to predict the Bank of Japan because they do like to surprise. We're going to be getting the quarterly outlook projections. So any hints, whether in the projections or in Governor Ueda's press conference, that there is a possibility of rate hikes, say at the next meeting in December, or maybe even in early 2025, I think that would be quite positive for the yen, given that in recent weeks the yen has actually now started to decline again against the US dollar. And that also that change in the yen, that 1 minute is too strong now, the yen is falling again. That could also influence BoJ policymakers, because if the yen continues to decline and basically we see a reversal of the earlier gains, then that might encourage BoJ policymakers to once again think about rate hikes. At the moment, though, I think markets are looking towards the middle of next year for the next rate hike.
Let's see if we'll have any surprises from the Bank of Japan. Let's cross into Europe now, Rafi. Flash inflation and GDP data are on tap this upcoming week. Could these data sets offer the single currency any support?
Well, probably not much support coming from the data, because the GDP growth in the third quarter is expected at 0.2%. That's a very sluggish figure, and we saw similar pace in the second quarter, because of course we know that the German economy continues to struggle. I don't think there's much chance of an upside surprise, even if there is a 0.3% instead of 0.2. I don't think that's going to really do much in terms of changing the outlook for the euro area. Now with inflation that had of course fallen a bit faster than expected to 1.7% in September. Now in October it could tick up to 1.9%, but the ECB is already forecasting a bit of a pickup in inflation towards the end of the year. So I don't think it's going to really change anything in terms of the policy outlook for the ECB. But of course, I think if inflation in particular, if it surprises to the downside, I think that's going to encourage investors even more to bet on a larger than expected 50 basis point rate cut by the ECB at its December meeting, and that of course would drag the euro further down against the greenback.
And Rafi, before I let you go, is there anything else on the upcoming week's calendar investors should keep an eye on?
Well, I think it's worth to also keep an eye on the UK budget. That's on Wednesday. So this is going to be the Labour government's first budget since coming into power in the summer. And there is talk of big tax hikes. We could have tax increases amounting to £40 billion. So on the whole, we are looking at significant fiscal tightening in the UK, and in terms of the impact on monetary policy, this of course means that the Bank of England it's going to be easier for them to cut rates, because there's going to be tightening from the fiscal front. So that would be seen as dampening demand in the economy. So that would be basically also dampen inflationary pressure. So the BOE, they would basically get the green light to be a little bit more aggressive. So sterling could in fact come under pressure if the budget, if we do indeed get the rate hikes, the tax hikes that are being reported in the UK media. One thing to note though is that maybe on the whole, if investors basically become more confident about the UK economy, because not just, of course, that the Labour government is being mindful of the UK's big budget deficit, but also thinking more long-term, and the budget includes a lot of long-term measures to boosting growth and investment. Maybe that might limit any sell-off in sterling. And finally, let's not forget about Australian inflation. The quarterly data is coming out next week as well. And we've got the RBA policy decision coming up in early November. So I think this is going to be crucial in terms of not that because they're likely to cut rates in November, but maybe they might signal a more dovish stance and maybe even start to debating a rate cut if inflation falls further in Australia, because it had been rather sticky earlier in the year. The monthly rate only recently fell within the RBA's 2 to 3 target band. So if you see the quarterly print, which is kind of more important because the monthly ones are kind of experimental stage still. So if we see Australian quarterly CPI fall to 2.9% as expected, I think maybe RBA might start to shift its stance a little bit, and that might add some pressure on the Australian dollar.
It definitely looks like it's going to be an exciting week for the FX markets. Rafi, thanks so much for joining me. This was the week ahead at XM.com.